Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our commentary on economics and market events. Let's get started. This video is another in our series of what we call Investing 101. Some of the basic concepts that we think investors should understand as they approach financial markets. So this video is going to be devoted to a subject that's near and dear to my heart, bonds and bond pricing, because that was where I got my start in the investing industry. Now, bonds are inherently mathematical, and that's one of the things I really love about them. But I'm going to try my best to explain the basic things investors need to know about bonds that without using any math that you didn't learn in the second grade. Let's see if I can get away with that. All right, so first of all, let's remember what a bond is. So a bond is, they call them also fixed income instruments, and it is basically a contract. And I've drawn up about, a 10-year bond. And let's say this is a 10-year bond that's paying you 1%. And let's say this is an annual pay bond, because they have those in Europe. We usually pay every 6 months, but it makes it easier if we say this is an annual pay bond. And basically what it means is you're going to pay somebody, in this instance, $100. So that's money out of your pocket, and you're going to get $1 a year. And then on the 10th year, you're going to get $1 of interest and you're going to get your money back. This is a bond. It's very simple. This is why it's all about math, because the cash flows, the day you buy it. We could get into complicated bonds like mortgages and so forth, but for the most part, the most common type of bond, the cash flows the day you buy it. You're going to pay a certain price to buy it. You're going to get interest payments every year. And then at the end, you're going to get another interest payment and you're going to get your money back. Simple, easy peasy. All right, but here's where things get confusing. People say, well, wait a minute, bonds have risk, right? The most important risk in bonds that people sometimes overlook, but it's that, okay, somebody promised you to pay all this, and what if they don't? What if they default? That's your biggest risk. And people who bought bonds in Enron or in MCI or a whole bunch of other companies, they found out, oh my gosh, it really hurts when people were supposed to pay me all this money and they don't. That's the biggest risk in bonds. But if you buy investment grade bonds, if you buy government bonds, those defaults don't happen very often. So the risk that people mostly focus on and talk about, and the one that I'm going to discuss today, is interest rate risk. And if you've seen some of our other videos, you know that we think that there is a potential when the Fed stops printing money and buying U.S. government bonds, well, taking that big buyer out of the market might push interest rates up. How will that impact bonds? Well, bonds are related to interest rates in what we used to always say is the teeter-totter. When bond yields go up, bond prices go down. And that may be confusing to people because, wait a minute, I'm still going to let's assume that this is a U.S. Treasury bond. There is absolutely no chance that the U.S. Treasury is going to default. Why would they? They can print more dollars and pay you your money. They're never going to default because they owe you dollars and they get to print those dollars. So no default risk in U.S. Treasuries. All right. And yet, if yields go up, your price is going to go down. And you're like, why? Because they're still going to pay me exactly what they promised. All right. That's what we're going to work through today. Why do bond prices go down when interest rates go up? And what simple question can you ask about a bond that'll give you a really good idea as to how much it may go down as interest rates go up? Okay? So first of all, why do bond prices go down when interest rates go up? So let's assume that it's January of 2022 And the Federal Reserve has turned off the printing press. Now, before you panic, they're only talking about reducing the amount that they buy in January of 2022. They're not talking about turning it off completely, but for the moment, let's just assume they say we're turning it off completely at the end of January. They surprise people by announcing that. Now, at the beginning of January, you bought a bond that pays you 1% for 10 years, and you paid the face value of that bond. You paid 100 cents on the dollar for that bond. And it's going to pay you $100. It's going to pay you this. All right? Now, 1 month later, the Federal Reserve has turned off their printing press, and suddenly, for that exact same bond, people don't want 1% anymore. They want 2%. All right? How does that impact you? Well, trying to ignore the X, and imagine that if right now it's a new bond, they're paying $100 for it, but instead of 1, they're getting 2, 102. Now, if they can buy a new bond that pays this, do they want your bond that only pays that? Of course not. Not if you're going to ask $100 for it. So essentially what has to happen if interest rates go up after you buy your bond, you bought it here, you bought it at a 1% yield, interest rates went up, all right, the price is going to have to fall enough to compensate people for the difference between what a new bond pays them and what your old bond pays. Now, what's the difference between these two cash flow streams? It's $10. All right. So, because this bond obviously pays more than that bond, they're never going to pay you the same amount for the two bonds. How much do you need to drop the price of your bond in order to entice people to buy it from you when they could buy this better bond instead? All right, so the cash difference between the two bonds is actually, if you added up these cash flow, it's $10. No surprise there. This one pays you an extra $1 a year for 10 years. So there's a $10 difference in the cash that these pay. So you might think your bond price would fall to 90 so that they would get an extra $1 at maturity that would compensate them for not getting these interest payments. The math is a little more complicated than that because $1 10 years from now is not worth the same as $1 right now. All right, and if you actually work through the math, give or take, your price has to fall to about 92. So it has to fall $8 instead of $10. So it's not the full 10 that's the difference between the new yield and the old yield cash flow, but it's a lot. It's a big chunk of it. All right, so when interest rates rise, bond prices fall. There's a possibility that interest rates could be rising when the Fed turns off the printing press. So how can you know how much risk you have in your bond portfolio for rising yields? All right? And this can be the risk that you have in individual bonds that you own or ETFs and mutual funds that are a package of bonds. Now, but the concept that I'm going to talk to you about is the same for all of them. There is one huge difference, and that is that if your price fell to 92 on this bond, so it's no longer 100, it's 92. If you own an individual bond, you can hold your nose, you can wait 10 years, and you will get your money back. All right? Now, that still means you will have only gotten 1% when everybody else was getting 2%. But that's the thing that you can do when you have an individual bond. Someday they mature and you get your money back at face value if that's important to you. If it is an ETF or a mutual fund, ETFs and mutual funds never mature. They always have about the same amount of risk. So in that case, if interest rates rise and your bond price falls, on your ETF and your mutual fund, the price is going to stay at that lower level until and unless interest rates come back down. So it's important to understand what are the likely, how much does the bond price potentially fall? And that can be measured roughly by its maturity. All right, this is the most simple and easy and second grade math way. If you remember, the bond was a 10-year bond. Interest rates went up 1%. They went from 1 to 2, so they went up 1%. And if you think that there's going to be a pretty tight connection, the actual change in the price was 8%, so it went down 8% when interest rates increased. All right, that's pretty connected to its maturity. So the maturity is pretty proportionate to the risk for fixed rate bonds. If it were a 5-year, then that number would have been about 4.5%. If it were a 2-year, that number would have been about 1.8%. All right, so you can see that maturity is a pretty good proxy for how much risk. If you want to take it one step further, because obviously this isn't 10, and when you get to 30-year, well, it's not going to go down 30, it goes down maybe about 18%, which is a long way from 30. All right, so the longer the maturity, the bigger the gap there is between the actual interest rate risk and the maturity. But nonetheless, no question, as maturity gets longer, your risk of rising rates increases. But it doesn't increase one for one. So what tells the exact risk here? How can you be a little bit more precise? And that comes from a number called modified duration. And modified duration, you don't have to know how to calculate it. You just have to ask or look on the description for your ETF or mutual fund, and you will find modified duration somewhere on there. And that'll tell you how much interest rate risk it has. And it may say that your ETF or your bond, because you can also ask your advisor, you know, what is the duration of this individual bond that I own? And you know, these are fairly standard calculations that are available. And if you have an 8-year duration, what does that mean? It means a 1% increase in rates will lead to an 8% decrease in the price of your bond. Duration's really easy to use. All right, so a 30-year bond will tend to have about an 18-year duration. A 2-year bond has about a 1.8. And you can use this number the same way for all of them. A 1% increase times this number tells you how much your bond price will go down if rates fall. If rates rise. And it will also tell you, in the unlikely event, because interest rates are at historic lows, if they go down another 1%, it'll tell you how much your price can go up. Because if this number is a negative instead of a positive, then hey, bond price goes up instead of down. So, just to summarize, interest rate risk in bonds means that when yields go up, bond prices go down. How much do they go down? Well, they go down roughly in proportion to maturity. So if you can't remember anything else, know that a 2-year bond is a lot less risky than a 10-year bond, which is a lot less risky than a 30-year bond. All right? And if you want to know a little bit more about exactly how much risk you've got, well, ask for the duration or look on the fund description sheet. Get that modified duration. That number will tell you, put a negative sign on that number, and that'll tell you how much your bond price will go down if interest rates go up 1%, which means from 1 to 2%, from 3 to 4%, whatever the current yield is. If it goes up 1 percentage point from that, that duration will tell you how much your bond price will go down. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. Also, if you'd like to see our other research, you can see it at caravelconcepts.com. Thanks.